One.
Well, good afternoon, everyone. My name is Rich Harvey, CEO and founder of Property Buyer, and welcome to our webinar today. Today, we've got two very special guests. We have Theo Chambers, who's the CEO of Shore Financial, and we also have Dr. Andrew Wilson, the Chief Economist from My Housing Market, who I'm sure you've seen quoted many times in the media. So we've got a power-packed hour and a bit of information. I would encourage you, if you do have a question, just jot it into the Q&A section at the bottom of your screen, and we will endeavour to have a 20-minute or so Q&A live section at the very end of this webinar. It is some really good information. So lots been happening in the economy. Have we hit the bottom? Is there a false dawn happening? I'm sure you've got lots of questions there. So today is really to help you get educated, to make informed decisions, to get away from the media spin and get a real understanding of how you can get into the property market, get the right kind of finance and the right structure around your investment portfolio and make better decisions. So without further ado, Theo, I'd like to hand over to you, please, just to give us a bit of a snapshot. What's happening in the lending side of things and how can borrowers manage this high interest rate environment, please?
Yes, thanks, Rich. Thanks for the introduction. So yeah, lots going on. I feel like interest rates and the RBA have never got so much coverage as they do today. It's all eyes have been on the housing market and RBA's movements the last sort of 12 months. Yeah, I agree with Andrew's comments earlier. Whilst Tuesday was a surprise to a lot of people in the increase in the interest rate, it was needed. Probably should have happened last month, I agree. But yeah, look, these interest rate movements are affecting all sort of parts of the market. What I'm hoping to cover here is a bit how it's affecting, firstly, the current mortgage holders, current borrowers, but also how it's affecting buyers, people out in the market and house hunting at the moment. So I'll dive into this. So I won't probably harp on too much about this because I'm sure Andrew's got some good commentary around this. But in a nutshell, everyone knows now. I'm sure you've seen now that we've had 11 increases in the cash rate in the last 12 months, 3.75 increases in 12 months, which is the most aggressive increases we've seen to the cash rate on record being the last 30 years. However, I think this elevated period will be short-lived, and I think there's a bit of an opportunity out there for buyers. If you're looking to purchase a property, people are in a bit of a limited ability to borrow money at the moment, so you will be faced with less competition at open homes and auction rooms. Like I said, I won't dive too much into this, but something that I thought is quite relevant is to show in the last 25 years what's happened to the cash rate. And something that is quite clear from this summary is that this chart, I should say, is that every time we've seen the cash rate increase, you'll see there 3 times apart from the most recent times, 3 times in the past, we've seen an increase. It's followed closely by a decrease. That's because each time the government's trying to manipulate the economy in some way, shape or form. Once they've achieved what they've achieved, they then, turn the knobs and go back the other way to re-stimulate the economy. Same thing happened in the US. The US is a lot more aggressive with their movements. The US interest rates affect the US economy in a different way. Ours are probably more correlated to the housing market. Over there, it's more correlated probably to businesses and companies, mainly because people take 30-year fixed mortgages over there as well. They've been a lot more aggressive recently on that increases. They're at a range of 4.75 to 5% on their central bank interest rate. But they were increasing last year by 75-point increments at one point in time. We have seen that these interest rate increases are taking effect to inflation. So they are achieving exactly what they want to achieve. In Australia, we've had 3 months now of consecutive decreases to inflation. In America, you could see that they started tackling inflation a little bit earlier than we did. And it is also having the desired effect. So personally, I think we're We're in the recovery stage. There no doubt might be some ups and downs ahead, but we've seen also that in the last 2 months there has been property price growth recorded on CoreLogic across the country, not just in pockets of Sydney or whatnot, but nationwide. So, like I was saying earlier, two sides of how these interest rates affect consumers. One is the current borrowers, current mortgage holders. So here we've got a summary of each increase and the respective repayment change for a $500,000 loan. We won't go through every single increase, but at the bottom right corner there, you can see that a $500,000 loan has increased now by about $1,000 a month, $1,081 to be precise, which is a significant amount, for a landlord that does eat away at your yield. And for an owner-occupier, that will make a substantial difference because obviously that's a net after-tax expense. If we look on a $1 million loan, it's essentially double. So on a $1 million loan, we've now seen about $2,153 in repayment increases. Something interesting to note on that far right column is that even though some increases are proportionately the same in percentage points, being 25 points at a time or 50 points at a time, the dollar amount doesn't increase respectfully. That's just because of amortization, the principal reduction of a 30-year loan term. So it does get slightly more and more as the rates go up and up. This is also something worthwhile noting. We see a lot of this sort of commentary in the media about the lag effect of each rate movement. So not when the RBA gets together on that first Tuesday of every month and make an announcement on increasing the cash rate. It's not like that instantly affects homeowners. It does take a little bit of time before it equates to a full month repayment, potentially 3 months. And to explain that, we saw on Tuesday, we had an increase. Only a handful of banks have announced what they're doing. Once all the banks do announce what they're doing, and let's say a week after that announcement, it won't be effective straight away. It'll probably be effective, let's say, by the end of this month. And then interest is typically charged, or interest is always charged in arrears. And depending when your repayments come out, your repayment cycle might be mid next month, for example. So if the increase becomes effective at the end of this month, then it's only going to be 2 weeks of your repayment that's felt the increase in interest. So it won't be till July that you effectively have a full month's repayment increase from this week's announcement. So a bit of a lag effect. And we probably only just started seeing the last increases come full effect recently. This is an interesting one that's spoken about a lot. There's some negative connotations to this in the media a lot. I think that you've seen the terms mortgage cliff. This is as this being referred to. So essentially, there's about $370 billion worth of fixed loans coming to maturity this year. This is CBA's data, but it is sort of proportionate across the board with all the banks because it's effectively the fixed rate loans that people took in COVID. So all through 2020 and 2021, and even at the start of 2022, you could apply for 1.99% fix or even 1.89 with lower terms for up to, say, 3-4 years. That's all the fixed rate loans now coming to maturity there, you can see. A wave of that is coming to maturity in June, and another wave is coming to maturity in December. What are we seeing here? We're already having conversations with these borrowers. People these days, I feel, are a lot more acute to their finance arrangements. They're not ignorant to the fact that their fixed rates coming to maturity and that it's going to be a much higher rate. It's not going to be a surprise for anyone. People are already planning and speaking to us, and if they think that they're going to have hurdles in making those repayments at those higher rates, they're planning ahead and having those discussions with us now already. The reason why a lot of people already know about what the variable rate most likely will be is because not many people take a fixed loan without a variable component. So what I mean by that, let's say you're borrowing $1 million, a lot of people will probably fix, let's say, half of it, 500 grand, and leave another 500 grand variable. So a lot of people are already seeing their repayments increase on that variable portion and are privy to those changes. So there is an argument, people say, that we're going to see a huge increase in supply because of supply of housing and new listings, that is, because of these fixed rate loans coming to maturity. I'm not sure that will be the case because we haven't seen a huge uptick in mortgage arrears. It's not like people are already struggling to make repayments. And there is some data out there, ABS and RBA data, that shows that people accrued a lot of cash in their offset, in their redraw during that COVID period because of that low interest rate environment. Plus, you could pause your repayments for 6 to 12 months, and there was subsidies and a whole lot of things to stimulate the economy. So I think personally that people are going to be in a position to weather that period of high repayments. So that's mainly all the changes on mortgage holders and existing homeowners. For buyers out there looking to buy a property, the flip side is how these interest rate changes affect their borrowing capacity. It has affected the capacity in substantial ways, you can see here. So this is a summary of each movement, and on the far right column, you can see the subsequent decrease in their borrowing power. So we're now at about 39% decrease in borrowing abilities from these increases in rates. The bank isn't also assessing affordability at current rates. They are applying a buffer of about 2.5 to 3%. So they are assessing your affordability at, call it 8.5%, potentially even 9%, which is probably a little bit excessive. There has been discussion whether APRA, the banking regulator, should loosen those lending guidelines. But APRA recently came out and said that they're not going to interfere with the federal government's intentions of tackling inflation. But once we see inflation at that targeted level, I wouldn't be surprised if we see a loosening toward lending to fix this problem right here in front of us. But yeah, no promises on that from anybody. Lastly, I won't cover this too much because I'm sure Andrew's got more comments on this, but all the major bank economists, this is an interesting one. I've never seen the major bank economists change their opinion or their forecast, I should say, so often as they have recently. My favorite economist is Westpac's Bill Evans, although he's in the last 6 to 8 weeks, his forecast has gone up and down and all over the place. He was forecasting a cash rate of 4.1%. Now this is outdated, obviously, because we've seen an increase already this week. Ironically, the economists that got it right this week, so only one of these 4 economists predicted that the cash rate would increase this week, and that is CBA's economist. That same economist is forecasting that we could see 1% in decreases by May next year. So a cash rate of 2.85% within 12 months' time. But yeah, I'll let you comment on that one, Andrew.
Thank you, Theo.
Thank you so much, Theo. That was wonderful. Yeah, it'd be interesting to see if APRA does loosen it as and when the cash rate's down. Yeah, great. So, Andrew, if you'd like to share your screen and move into your section. And yeah, thanks for so much, Theo, for that. Please hang around for questions at the end. I'm sure people have got some good questions to ask. But over to you, Andrew.
Yeah, thanks very much, Rich. And we've got a lot to cover, so I'll be speaking quite quickly. We want to finish up at around about 1:20, and so that allows plenty of time.
25 past now, yeah.
25 past, that's even better. So I don't have to speak quite so quickly, but it is about the main points, and that's what I do want to cover. Sorry, we're just going to have a...
It was a good point you made, Theo, about how the economists changed their opinions, mate. But it's all based on assumptions, right? All good economists have a lot of assumptions. So.
There's also just constant new data being released, which does influence their forecast.
Yeah.
Yeah, but I must admit, if anything's positive about bank forecasts, they're always wrong. So at least they're consistent in that respect. I've noticed, and we'll speak about that today, they've all backtracked significantly on their forecasts for house prices this year. We shouldn't be surprised. They did exactly the same thing through COVID. Went over the top in terms of predictions of house price crashes. They did the same thing in 2018-19. They've done the same thing now, and they're wrong again. Anyway, we move on. My brand is My Housing Market. I operate as an independent commentator and data provider for the housing market. I'm all about the current state and future prospects of housing markets, particularly emphasising that current state. I think if you're a talking head in anything, you've got to have some qualifications. I have qualifications in housing market economics and pure research. So I guess it gives me some substantiation to be talking to you today. I'm also a member of the Royal Institute of Chartered Surveyors, which means I have a skill set in measurement. And my measurement, of course, is the housing market and the broader economy. I've also had a lengthy career as an economist, a property economist. My last formal role was with Domain, where I finished up in 2017 and became a consultant, where I've been ever since. And I do provide regular insights for Rich and his colleagues. So good to be back here again. I also get my head in the media from time to time. Not so sure that's positive, but I think I'm regarded
positive, mate. Anyone with that hair is positive, mate. Come on.
Well, I think I'm regarded as a bit of a straight shooter amongst all that clickbait, which seems to be growing exponentially. So bits and pieces there, but we're not here to talk about me. We're here to talk about our housing markets, their current state and future prospects. And there they all are in their glory. No doubt that home prices are rising in 2023. And guess what, Rich? They're rising everywhere. And it's not just a one-off. We've now had 3 months of national house price increases. And the latest data, which we'll show you today, which is from My Housing Market and is, of course, for the April quarter, shows that every capital city recorded higher house prices. And they all also recorded higher unit prices, with the exception of Hobart, which was flat. But when we look at our housing markets in terms of analysts analysing, I like to look at three principal factors. On the demand side, of course, people, and as we found out through the COVID experience, in migration is an important driver of housing market activity, particularly when you stop migration by shutting the borders. Now, we've had two factors there. We've reopened our borders, so we're getting a surge in international migration, which of course is fueling demand. And of course, we also had shifts in interstate migration with those severe lockdowns in Melbourne and Sydney, creating a big exodus out of those cities into southeast Queensland and Brisbane. The Gold Coast really did experience very strong prices growth. So we'll have a quick look at migration, how it stands at the moment. But on the supply side, of course, we need to match increased demand with increased supply. That's not what we're doing at the moment. In fact, Australia's probably never had such an underbuilt environment as it has now. We really did stop building houses back, and homes, units particularly, back in 2015-16. And now all the constraints that we have, green tape, red tape, planning restrictions, that aren't going to go away. We now have skyrocketing house building costs, which will even make it harder to match demand with supply. But of course, we need to match supply and demand, or the glue that holds those matches together is the economy. And when we're talking about the economy, particularly in regard to the housing market, we talk about interest rates. And interest rates, of course, are important because they, as we've already heard, they do impact affordability. Higher interest rates make property less affordable with a given income. Of course, lower interest rates make property more affordable with a given income. And but it's not a one-on-one relationship with changes in interest rates. What we see when interest rates rise, other than the initial shock factor, which impacts confidence, is more a flattening of house price growth rather than a falling. That's the historical evidence. A lot of buyers and sellers sit on their hands and wait for the skies to clear or to regain their confidence. So when interest rates do drop, we have all that pent-up demand waiting to be released. It is released, and we get very strong prices growth once we do get lower interest rates. Of course, the Reserve Bank sets interest rates nationally. There is no local interest rate policy. So that means all capital cities are affected by interest rate changes. But even though the trend is similar in terms of changes to rates up or down, local factors do determine the rate of growth of individual markets. And those local factors are, of course, migration, level of home building, and what's happening in the local economy. So let's have a look at the interest rate cycle. These are mortgage interest rates. average mortgage interest rates since 2005. You can see we increased rates up through mining boom number one, perhaps we could call it that, Rich, up to 2007. We actually had mortgage rates peak at 9.5% at that period. But of course, then we had the GFC. We had to move into reverse gear, cut rates to stimulate demand. Mortgage rates fell to 5.8. Australia was saved, unlike the rest of the world, which continued to struggle. We had a mining boom number two. Again, higher inflation meant higher interest rates from the Reserve Bank, higher mortgage rates. Then we joined the rest of the world when our mining boom finished. Down, down, down. We cut our rates to near all-time lows. We had a couple of bleeps there where the Reserve Bank didn't act to raise interest rates, but APRA, the financial regulator, did because they perceived that there were too many investors in the market at that time. And they were predicting wrongly, of course, that interest rates were going to rise pretty soon during those periods, and they wanted to protect the market from a shedding of investor activity through higher rates. They were wrong there. But one of the significant consequences, in my opinion, from those unprecedented APRA actions was that we restrained investor activity, and guess what? We've run out of housing, Rich, particularly investment housing, and we have the worst rental market in our history at the moment if you're a tenant, particularly a new tenant. But of course, along came COVID. We moved into reverse in terms of interest rates hitting the bottom, just 0.1%, record low. Lots of stimulus packages through then meant that we spent like drunken sailors, governments across the globe, to try to keep economies ticking over. And of course, that meant that once the lockdowns were behind us, thankfully, and I'm not criticising the stimulus packages, we had to pay for that. All that, what was paid forward, now has to get paid back because, of course, it created a lot of inflation, particularly through the mismatch between significantly higher levels of demand and lower levels of supply to match that. So we now have official inflation. This is March quarter data. We'll look at the latest numbers shortly, Rich. Up at interest rates are now at 7.8%. We will look at inflation shortly at 7.8%, those mortgage rates. I think it's a little interesting, Rich, and I don't want to be naughty here, but the interest rate now, the average interest rate is 7.8%, which is, of course, the same as we had back in 2011 at the peak of the previous tightening cycle. However, our interest rates, our official rates, are actually 1% lower. So the banks have been catching up with their margins through that period over the last 12 years. But that's a conversation for bank competition, and maybe they should try to be a bit more focused on the consumer and getting it right there than on their economic forecast, where they just can't seem to get it right. But they're certainly performing better with an increased margin despite interest rate changes or interest rate levels being the same. But we're interested in house prices, Rich, aren't we? So let's have a look at how house prices have responded. We can see that up and down movement. As I've mentioned before, lower or higher interest rates tend to flatten house prices. Lower interest rates tend to see house prices take off, and that's a lot to do with the release of the pent-up demand that higher interest rates create. We can see they're looking particularly at Sydney. Its journey has been, interrupted by, firstly, the end of that very strong boom in 2017 and into 18. We then had a significant fear factor invade markets. There were lots of predictions that house prices would fall by, can you believe, up to 40% in 2019. I think the person who made that prediction has now left the country, but that's another story. But nonetheless, we did see it probably similar to what we're seeing now, that buyers did start to move back into the marketplace because of value perceptions, and that was that they realised that prices were around about 10% lower than they were the year before, and that started to bring buyers back into the market, despite the fact that we had issues with confidence at that period. I'm talking 2019, where, of course, we had the Banking Royal Commission, the Banking Sector Royal Commission, and, of course, the Labor Party, who were then in opposition, were proposing to get rid of negative gearing. Now, once that was all clear, the Reserve Bank finally realised that its policies on interest rates had got it wrong. They were left too high for too long. They cut interest rates savagely over the back half of 2019. That just added to the revival in housing markets. And of course, as we can see, we had housing markets take off quite strongly. Along came COVID just to ruin the party. Lockdowns meant, of course, that people couldn't get out and buy and sell. There was a lot of predictions also then that prices would collapse. It didn't happen because as soon as lockdowns finished, buyers and sellers were out and about and making up for lost time, Rich. And we can see the impact there of lockdowns on and off on prices growth on and off. But since the end of the last lockdowns in 2021, all that pent-up demand has been released. Sydney gone through the roof in terms of house prices. Melbourne also, Brisbane being, and that's the third cycle there. Melbourne's the black one. The third one there is Brisbane, and that's also got very strong, had a very strong period of growth in 21, and that was driven by interstate migration. So I think what's the pertinent point with this chart, Rich, is to actually look at the cycles. And if we look at the Sydney cycle, you can see clearly the upturn that's been generated really from September last year. And the trough of the market was winter last year, which is pretty typical anyway, the winter market. But we did see, even though prices were continuing to decline, that the rate of decline was easing, particularly in Sydney and Melbourne through the back half of last year. No surprise, of course, that we've now got prices rising again. It's just really following the trend. So we just look at the trend, it can tell us that things were improving despite 10 consecutive increases in interest rates, which really the housing market and consumers have shrugged off. And we'll look at the data that supports that. And that's why, you know, that April pause was just remarkable, given there was nothing to substantiate it. And also those predictions that rates would remain on hold over May was even more bewildering, given the latest data is even stronger in terms of what's happening in the economy. So that's the story with interest rates and house prices, Rich. Just quickly, the rate outlook has sort of cleared, I guess. No surprise that the REA has resumed rate rises over May after that decision to hold them over April after 10 months of rises. Inflation is still significantly above the target level. The economy continues to boom, record low jobless, strong rising retail sales. We had the latest data yesterday. And guess what? House prices are still rising again. So higher interest rates haven't scared off home buyers, Rich. They're back and at it. And I expect that to continue to have momentum, to gather momentum over the back end of the autumn selling season. So there we are, 3.85%. I think one of the factors that's sort of moderated the impact of higher rates is we're still 1% below where we were back in 2011. This is a very low interest rate historically, Rich. Just under 1% lower than where we were in 2011. And of course, we have a booming economy, still have reasonable savings levels, and wages are rising at the fastest level in 10 years. And this is a significant offset to this steep increase in interest rates, which we're still not back to where we were in 2011. I do think that pause bolstered an already reviving housing market. Confidence has started to rise. Prices are still lower than a year ago, Rich. Hey, it's deja vu about 2019. And I think that's the value aspect that buyers have, that, yeah, prices are rising, but if I stay out of the market, I'm only going to lose out in terms of the relationship between prices now and a year ago. And the May increase obviously indicates that more rate rises loom as inflation prevails, and we'll look at that shortly. I just wanted to mention, and I won't go too hard on the poor old RBA because everybody's putting the boots in at the moment, the combination of higher interest rates, and this is from Tuesday's statement, cost of living pressures and the earlier decline in house prices. And note they're now saying the earlier decline. They've put that one in now, conceding that house prices are rising. Of course, the RBA was amongst many who got it wrong on house price declines. Is leading to a substantial slowing in household spending. Don't know how they can work that out. How there's a substantial slowing in household spending. Home prices are rising across the board. Retail spending is still strong and rising. So please explain, Reserve Bank. We had the retail data out yesterday. It's shown another increase over March, and it was a higher increase than was recorded over February. But we'll look at that data in just a second. The economy is still booming. Another stunning result for the labour market over March. And as I said, no justifications, in my opinion, for that rate pause, as consumers don't really care after those 10, it seems anyway, they don't care after those 10 consecutive rate rises. And here's the wonderful labour market data, Rich, 3.5%, record low unemployment for the monthly survey. It's the lowest result we've had since the early 70s. And of course, in the early 70s, we had a completely different society. There was basically one breadwinner per household. And now we have, of course, a much different, much varied breadwinner profile in our households. And we're still, got a record low unemployment rate. States, the capitals are all doing well. No surprise, Sydney has the lowest unemployment rate, and that's helping to drive its housing market upwards. The jobless unemployment rate was steady over April at 3.5%. We actually saw another increase in jobs, second month in a row with the number of jobs rising. Unemployment was down. The number of unemployed was down, also 2 months in a row. The participation rate is near a record level, which means we're dragging people out of the population at levels we've never seen before. And as I showed before, capitals are reporting low unemployment rates, and those 11 months of increases has no impact on the real economy. And the real economy is all we can work on in terms of the data going forward. So I think the Reserve Bank realised that they'd come in a little bit too early if they were waiting to see what had happened. We need to see at least some signs, please, on the consumer data to think that we're getting some results in terms of slowing down our economy. As I mentioned, retail sales higher. Look how much higher retail sales are now compared to where they were pre-COVID. It still reflects all that boom, all that stimulus packages that we have, and still way too high, I would suggest, for the RBA's comfort. Wages are rising at the fastest rate in 10 years. That helps to offset higher interest rates. I think we've got a lot more wage increase, or more wage increases in the gun. Of course, Australia has a much stickier wage setting policy compared to, say, the US. We typically have annual or even 2 yearly wage reviews, so we've still got that to come in a lot of workplaces. So I would expect to see wages continue to rise, and of course, inflation is also driving wages as workers try to bid up their wages as prices rise. We'll look at that now with inflation. Yeah, inflation fell. This is underlying inflation down to 6.6%. This is the preferred measure from the Reserve Bank. Now, let's understand that the target for the Reserve Bank is 2 to 3%. We are at 6.6%. So they're heading for 3%. Good luck with that. And their recent predictions are that 2025-26 is when we'll get back to the high point.
Just on that, Andrew, do you think that's a ridiculous target to aim for? That's so low.
Well, I understand that, Rich, and things do change. And part of the proposals that have been put forward by the government is maybe we have a flexible target. But let's look back to pre-COVID. And in those days, we're in bizarro world because we couldn't get inflation rising. It was in 1%, right? And we just couldn't activate our economy, you know, and the same was happening in the US and the UK. So there were suggestions there that we cut the target down to 1 to 2%. Now imagine if we had a 1 to 2% target now, we'd really be in the poo, wouldn't we? So I think it's a very delicate proposition to change the target. I understand that things do change, but I think the target of 2 to 3% is not just about, I guess, the nature of the macro economy. It's also a rational target because it keeps the value of money reasonable. You know what I mean? Although it does mean that we've got a lot of tough yards ahead of us to get back to that range as we stand. But yeah, look, this is one of the suggestions that's happening now. Personally, I think we've got to look a little bit more to fiscal policy and away from monetary policy to really get a handle on inflation, because, you know, it really is all about interest rates now. And that's got to mean, you know, as I said, we're 6.6. We need to be at 3% before there's any talk of a cut to rates, really. And we're a long way from that. We just have this very, very strong economy, Rich, going forward. And certainly inflation, the headline rate was down to 7 from 7.8. We just said that the underlying rate down to 6.6. March quarter was up by 1.4, which was lower than December and lower again than March last year. Travel and gas were the main contributors to higher inflation over the March quarter. There was some easing in new homes and fuel costs, but we're sort of still waiting in judgment on new home costs, which have fallen but are still very, very high. And fuel is looking a little better, the price of oil, but I think that's still a volatile measure. And of course, if fuel prices go up, that will work its way into inflation. The real issue with the latest inflation data, Rich, was that we're still seeing services prices rising. Services prices are now the highest since 2001, even though goods price growth is easing. But I think those goods prices growth would have eased without interest rate increases, because it was all about the mismatch through COVID of supply and demand because of the stimulus packages. And, you know, you don't have to wait 2 years to get a couch anymore or a new car. And that sort of tells you the story that it started to equilibrate supply and demand for goods. But the problem is services are now rising. And the reason they're rising is because we're getting a lot of wage increases, because we've run out of workers. Employers are having to pay more if they want to keep their staff. So how do they offset that extra cost? Well, they got to put up their prices. And when the prices go up, the workers say, hang on, I need a little bit more money to cover those extra prices. And this is the great fear. And we're seeing it mature a lot more in the US than here, that has a different wage setting system, is that, we're going to see that wages prices spiral starting to emerge. So really no reason to do a victory lap on inflation at this stage, unfortunately. And I believe that'll mean higher rates. But we are supported by, as I said, probably the strongest economy in our history, Rich. So building costs, I mentioned those eased a little bit in February in terms of the annual growth, but are still very, very high. This, of course, is a response to the stimulus package from the previous government for home building. And you can see how house building costs just have taken off since that stimulus package. The growth rate eased, but it's still very high. And if we look at the growth rates, annual growth rate in house building costs are 16.7%, Rich, which is crazy when you look at the back end before COVID. And this is making it very difficult for builders to operate, because builders typically operate with fixed price contracts. And when you've got prices rising, costs rising at that rate, it's very difficult to meet a fixed price on your contract. And we've seen that with a few issues with builders going forward. Prices are still right. The rate of growth is easy from those crazy numbers that peaked at 23.3%. This will also mean flattening of actual building, because those building approvals that do come through because of higher building costs are unlikely, and many of them are unlikely to actually get out of the ground. And we can see there that we would have thought that with fewer houses that would relieve building costs, but house building has continued to fall in terms of the trend, and it's not providing any real relief, lower house building numbers to building costs, labour and materials. I mentioned the price of oil. Yeah, it's sort of fallen significantly from its peak, and this has helped inflation fall. This has been the main factor that's helped inflation fall across the globe, has been that significant cut in oil prices, nearly half of where they were at their peak. But, there's some issues with oil producers at the moment. They're starting to talk about reducing supply, and that may mean we'll get back into that higher fuel cost environment. But it's a little bit 6 of one, half a dozen at the other. Half a dozen of the other, and but we need to keep an eye on those oil costs. But we have had relief from that, and that has certainly worked its way into lower inflation. I mentioned migration. Our target's around 200,000 permanent migrants. Rich, we're now seeing a flood of students come into Australia. China's opened its borders again in terms of getting rid of lockdown. It's encouraging its students to head off for a degree somewhere. And Australian universities and higher education facilities are all saying that they want to move back to face-to-face away from online. So that means, hey, lots more students coming into Australia. I think that's what's driving crazy rental market activity at the moment. And in an undersupplied market, this is bad news for tenants, particularly new tenants. Good news for landlords, and that helps to offset higher interest rates is higher rents. In fact, skyrocketing rents. And I noticed, we'll talk about this when we talk about the rental market. Well, I'll talk about it now. I noticed that all these proposals for rent control in the private rental sector, or the private sector rental market, that's cloud cuckoo land. And I think it's open for legal challenge, because if you want to control the income side of the equation by capping rents, you then must look at the expenditure side of the equation. Does that mean that these political parties that are proposing rent freezes, does that mean also they're going to have an interest rate freeze as well to offset that? So something to think about. Polly's out there. No such thing as simple solutions for this. And just remember that investors vote as well, and landlords all vote as well. So if you want to start crunching investors, there is some jeopardy involved, not just legal, but also political. Overseas migration, have a look at that. Rebounded since we opened up the borders. Interesting, Brisbane or Queensland is still leading the bunch, and this is the latest data which is the year to September, so it's a bit backdated. So that Queensland data is still influenced by the exodus out of the southern states through lockdown. But you can see there how Melbourne, or New South Wales and Victoria, Melbourne, Sydney, have rebounded very sharply in terms of net migration since since lockdown finished and borders were opened. In fact, New South Wales is now the leader in terms of net overseas migration. Typically, it is Victoria. And I think that's part of the story behind the Sydney housing market's revival, which is this big surge in international migration into New South Wales. As we saw, Queensland's still the top destination for interstate migration. But as I said, these are a little backward looking, this data, because it is the latest data from the ABS, which is to the September quarter last year. So supply, building approvals increased slightly over February, but it came from a low base, and it was because of a big rise in houses, which was from a low base. But units were still down, but total approvals are still down 30% over the year. This is the big problem, that we don't have supply to match demand. This is total home building. You can see the trend still falling, a bit of an uptick in February compared to January. Some issues here with the ABS's seasonal adjustment process. We need to take it with a grain of salt. But certainly we've come well off the mark since that peak through the home builder policies of early 21. Similarly there, when we look at the background, houses and units are both falling away in terms of new building. This is the data, the latest data. Even though we did have that uptick in houses and total building, you can see when we compare it to a year ago, it is significantly lower. And when we look at the underlying trend, we're actually 31.7% below where we were in 2016 in terms of what we're building. And you just can't get away with this, particularly when we're seeing a surge in demand coming through.
Just one quick question, just on that chart, Andrew. Like, you've got 130,000 dwelling approvals sitting right there.
Yep.
That's not actually what's built. That's just approvals. So
exactly.
my question is, I believe there's some figure of like 20 to 30% won't get built, particularly as construction costs are so high. What's your estimate of what will actually get built out of that 130,000?
Well, 100%, Rich. I couldn't agree with you more. And it's hard to tell. You know, we don't know what's going on out there. But typically most approvals become commencements. I think that we're going to see 10, maybe 15% fewer commencements in the same period of time than we would typically see from approvals. And that just makes it worse to try to match all this demand that we've got coming through.
This is the mathematical equation that I see is the major problem. If you've got, say, let's say we take 15% off that number, so you're down to like 115,000 dwellings, right? You've got probably 370,000 migrants when you add students plus temporaries and everyone else. And you've only got dwellings of 115 being built. I mean, how many rooms have you got at your place? Can you take a few?
Well, I think there's going to be significant social changes. This isn't going to change anytime soon. No. You don't just add water and you build 1,000 towers, because we probably need 1,000 towers. We probably need a million new homes to get our markets back into balance.
Well, this is my point. I mean, from an economics point of view, is the only thing I can see to the equation that's going to happen here is that rents will probably go 15 to 20% higher in the next 12 months.
Yep.
And prices for property will rise somewhere between 5 to 10% this year alone. And then next year, they'll probably do 10%. And I think you're going to find those that can't afford it will continue to move out of the cities, and you've got social dislocation. What do you think?
Exactly. And it'll be, the dislocation in the cities as well. More people living in smaller spaces, people sadly having to live on the street, maybe more pressure on, social services to house people, which means more spending from governments, which means, you've got to pay for it somehow. This is a very big problem, Rich. And what bothers me is that the solutions that are being promoted are cloud cuckoo land stuff. They're two-dimensional. They won't work. They'll probably cause more problems than they solve, particularly even the build to rent brigade that are obviously it's good news for them to a certain degree, but there's just not the capacity for the big corps to build.
But even if they started building it, 59,000 dwellings, that's 3 years away before you get a room, right?
And you need hundreds of towers. And the whole point to build to rent, for it to succeed, is it needs tax concessions from local governments. And the point is, once you build a lot of them, that's a lot of tax concessions which governments have to answer for, that are going straight into the pocket of the build to rent brigade. You know what I mean? So look, okay, it might work at the margin, but there are a lot of issues there. And certainly there is not the capacity to match our undersupply from build to rent, not even close. I think we're 1 million homes short at the moment, Rich. So,
so I didn't want to interrupt, but I thought I'd just make that point.
That's all right. I'm under the pump anyway, mate. So as we can see, when we break down the trends, it's really the units that have suffered the most in terms of that decline in trend building. And of course, units are becoming more popular, maybe more affordable, maybe, locational advantages, all those sort of things. Houses, the trend for houses was obviously improved through the home builder policy, but it's now falling away as well. And this is interesting also, Rich. This is the latest data for what's happening on a capital city by capital city basis. And, phenomenally, we're seeing Brisbane outbuild Sydney at the moment. So Brisbane is now outbuilding Sydney, which is just, for houses, for units particularly. So, that's quite, because Sydney usually, I was saying, oh, wow, Melbourne's outbuilding Sydney for units. Well, now it's Brisbane outbuilding Sydney for units. And this just exacerbates the problem in Sydney. They have run out of houses. And of course, it's what's pushing up rents and prices in that capital. So let's have a look at rental markets. Certainly those more amenable suburbs a year ago in Melbourne and Sydney for units that were offering higher vacancy rates and lower rents. Forget it. It's all gone. They've now, vacancy rates in those areas are now at low levels. Increased demand, of course, borders have opened. Falling supply, we've moved past the surge in new development for units that was a result of the boom in units in 2016-17. And of course, a lot of the Airbnbs have now moved back into the short-term market, Rich, which means that's taking supply out of the permanent market. And of course, we know that through COVID and post-COVID, people were looking for the home office, and that meant houses to rent became like hen's teeth. So this is the latest data for rents. This is the April data, monthly data. You can see amazing, Rich, that Sydney unit rents are now the same as house rents. They've been closing for a few months. Most of the capitals we're seeing units close on houses, except for Adelaide, which has a very small unit market, rental market. But our latest data is actually showing rents for units are now exceeding houses over the last week or so. So bad news there. Rents are still rising over the month. April's usually a quieter month for rents, Rich, because it's a holiday month. And you see, fewer engaged tenants and landlords, but still we saw house rents rising, and look how Sydney unit rents up by 3.3% over the month. Now, Melbourne, no surprise, it's rising because house rents were the most affordable, still just the most affordable of the major capitals, but they're in catch-up mode now. And that was because of all the migration that occurred out of Melbourne, left a lot of houses, vacancy rates higher, but now they're catching up those rents. Annual rents, this is crazy stuff. This is what's happened over the past year for houses, just amazing results. And for units, look at that 40% increase in unit rents in Sydney. And let's remember, this is for new listings and coming from a very low base in Melbourne and Sydney a year ago. But certainly big news for landlords and very sobering news for tenants. Vacancy rates, they did pick up a little bit over April with those seasonal impacts, just up a bit in Sydney and Melbourne for houses, but still very, very low. Let's remember 2.5% is probably the balance mark for vacancy rates, 2.5%. Above that, rents fall. Below that, rents rise. And we're now, under the ones, basically. And unit vacancy rates in Melbourne and Sydney are, they were 6 or 7% in Melbourne a year ago, Rich. And now they're back down to being very low levels. So that's telling us why they're rising. Now, I've got in this presentation, which you're going to send around, Rich, and if people have got their cameras out there, their phones, just take a really quick snapshot of that QR code. You're going to have another chance at the end, but I'll just give you 10 seconds, even though I am talking very quickly at the moment, Rich, to take a picture of that, and that will give you a copy of the latest My Housing Market rent.
Good on you. Great idea.
For April. So we'll move on into home prices, of course. Let's have a quick look at last year. Last year, it really was only Sydney and Melbourne where prices fell, even though the national house price was down. It is an amalgam, basically, of Sydney and Melbourne because it's based on a weighted average. But Brisbane, Adelaide and Perth all recorded higher prices, Rich, over the year. So, all that nonsense about price crashes last year and, the prices did fall. It was really Melbourne and Sydney. And it was interesting that actually units performed better than houses last year, Rich. In fact, Brisbane unit prices up by 11% last year, Adelaide up 10%, despite all those interest rate increases. So when we look at 21 versus 22, of course, we've come from a very strong period of growth in 21. So when we look at the results, versus 22, we're still well ahead in terms of that 2-year period. And I'll put it all together. And Brisbane clearly benefiting from that surge in migration. Prices up 34.6% over 2 years. Sydney up 23.8% and starting to rise again. And Melbourne up 16.9%. We did have those predictions of house price falls across the board again. In fact, we've only ever had 4 December quarter to December quarter falls in the median national house price since 1987, Rich. So this is the real data, man. This is what actually happens. And we've only had those 4 falls. The worst we had is 5.5% in 2018. And that 4.3% last year was just about where we are in our adjustment periods following strong booms. So no doom and gloom here, nothing to be frightened of, particularly given prices are growing again. And it certainly puts into perspective a lot of those predictions, particularly from the banks, of 10, 20, 30% rises in house prices over the cycle. Just doesn't stack up in terms of historical evidence, and certainly that evidence held true when we look at what happened last year. So let's have a look at the latest data, Rich. I'm not sure we've got time to do this. I'm just going to run this quick video. I have a reason behind it. So
prices have risen for the first time in close to
this is February data.
Our market has turned a corner, but with more rate rises looming, a mortgage cliff on the horizon, and murmurings of a recession, any road to recovery will be rocky.
Despite the cool down, the battle to buy a home in Sydney's south is feeling hot.
It's red hot, sort of a lot of people interested, so they're surprised at how much there is.
More than 80 interested parties have been through this home on the market at Miranda.
I believe it's pretty competitive, so there's about 21 contracts already out, so it's going to be a fight.
Economists hesitantly hopeful things are looking up.
There's some positive signs there that the Sydney market has bottomed out.
After 10 months on the decline, Sydney's median house price rose 1.4% in the February quarter. Overall, still down 7.8% since this time last year.
We're being refueled with high levels of migration in what is clearly still an undersupplied housing market.
At the moment, it's quite positive news because not as many people are wanting to sell. That's helping to keep supply contained and potentially stabilise values.
And it might depend on where you live. Sydney South has seen the biggest growth in the median house price, up 5.5% in the last 3 months. The Northwest and Canterbury Bankstown have also climbed, while the regions which have seen the biggest falls are the City and East, down 10.9%, the Northern Beaches dropping 4.9%, and the Lower North Shore 2%.
So certainly the mid-priced and lower-priced areas in Sydney that are bouncing back, with higher price markets still subdued.
When it comes to Sydney's property crystal ball, the future depends on the Reserve Bank. We've seen continuous rate hikes every month since last May, and that's expected to continue when the RBA meets again on Tuesday.
Okay, I've just got to get out of this. This is always the problem.
All right.
There we go. So the reason I had that was, most importantly, if you remember what the newsreader said at the beginning, this is February where we had our first rise. It was still all about the cliff and higher interest rates and a recession, which just tells you the flavour, I guess, of the insights into our marketplace. But that was the first rise. And now we're going to see what's happening since then, Rich. So this is the latest data, the April quarter data. So this is comparing April quarter to the previous quarter, which was the rolling quarter. So it's the April quarter versus the March quarter. You can see the third consecutive month of higher house prices. Other data providers, of course, are providing the same insights. Our data is very robust and resilient. And actually, our data comes out before anybody else, but it is reporting the same outcomes. This is the data in terms of the capitals. Sydney up by 0.8%, third month in a row. Melbourne up second month in a row. So maybe the Melbourne market's bottom. Every capital city recorded higher house prices over that April quarter compared to the March quarter. This year, Sydney up by 3.2% so far this year. Melbourne up 1.2%, and the Perth market continues to keep on keeping on, up 2.5%. Unit prices also rising, third consecutive month nationally. And all capitals, with the exception of Hobart, recorded higher unit prices over that April quarter compared to the March quarter. And Hobart was only down by 0.6%. Sydney unit prices up by 1.8%. Adelaide and Brisbane, so far this year, Adelaide and Brisbane have also recorded solid rises this year so far, Rich, with the latest data. I've just gone through that still rising, our house prices. Melbourne and Sydney look to have clearly bottomed out at this stage. Unit prices are also higher. And the RBA rate pause in April was a positive. And I think that really a lot of buyers and sellers have shown over the last few months that they've moved on from higher interest rates. Of course, I don't want to keep kicking the Reserve Bank, but they did have now conceded that, it's not going to be as bad as they predicted. And their excuses are, I'm a little disingenuous in my opinion. They reckon a growth in migration or population and nominal incomes. Well, we all knew migration was going to grow, and we knew how much it was going to grow by, and that's a given. And actually, their forecasts for incomes were higher than what has actually happened. So anyway, we move on. And of course, the ANZ have got it wrong again. And I just put this one in for a little bit of an insight. I don't know whether they got 9% last year, but they're now saying that all of the weakness in house prices are behind them, despite forecasting 10% this year. But again, it's deja vu, similar, road to Damascus, returns to reality from the major banks. So if you want a copy of that, of the house price report, I'll just give you a couple of seconds to do that, because we're going to finish up in a couple of minutes, Rich. So we'll be able to get those questions rolling. So that's the QR code for our April quarter house price report. So you're welcome to have a copy of that. If you take that QR code, you'll be able to download the link. So these are my forecasts for house prices this year, focusing on Sydney. I believe Sydney, these are mid-price forecasts. I haven't changed them for a couple of months, Rich. So, no changing as the data changes. Forecast is not a forecast if it changes every 5 minutes, and we see a lot of that. So I reckon Sydney 7%. We're up 3.2 already, so pretty happy with that. And units up 6% in Sydney for this year. So I've got all the capitals recording positive growth over the year. These are mid-price forecasts, so they could be a little higher or a little lower going forward. We look at the auction markets, just finishing off now, Rich, because they are a strong forward indicator of what's happening in our broader economy. You can see Sydney house prices and clearance rates track each other. Similarly, Melbourne house prices track each other. Last weekend, of course, was the last weekend of the month for auctions. Numbers are still down because the holiday month, April, is still impacting stock. But Sydney recorded its fourth 70% plus clearance rate in a row. Who would believe it? And Melbourne recorded its highest clearance rate, Rich, since, hang on, October 21. So that's the highest weekend clearance rate from Melbourne since October 21. So no surprise, of course, that relationship between clearance rates and prices is still holding. Brisbane still reasonable results, given a big surge in listings last weekend. Similarly, Adelaide still the strongest market with auction clearance rates above 80%. And Canberra a little better, and Canberra has been the underperformer. These are the results. Auction clearance rates in Sydney above now where they were a year ago. Similarly, in Melbourne, above where they were a year ago. Brisbane's still a little bit lower, but we've got to remember that Brisbane was booming a year ago on the back of all that interstate migration. Adelaide's still number one auction market with clearance rates continuing above 80%. And Canberra a little lower than the rest, but starting to pick up slightly. The Canberra market tends to follow the Sydney market upwards, but there are some local issues there in terms of the performance of the Canberra market, particularly, I believe, in relation to the impact of some new property taxes. So if you want those auction clearance rates, every Saturday night on my LinkedIn channel, Doc Andrew Wilson, you'll get the capital city snapshots. And then on Sundays, you get the full report with some regional breakdowns. So let's put it all together and finish off what's been a very long presentation. Not really. Inflation outlook remains clouded. Will interest rates peak lower and earlier than predicted? Booming national economy, however, is certainly well positioned to absorb higher rates. House prices eased last year, but improved over spring and have started to rise now. Interest rates do constrain prices growth and typically impact confidence in the shorter term. However, underlying demand remains above supply, reflecting recent underbuilding and the resumption of migration. And the housing market has rebounded significantly sooner than predicted. Home prices are now clearly rising in 2023. Sydney and Melbourne have bottomed out with consecutive increases. And that FOMO, I think, is now set to emerge, that fear of missing out, because values are still lower than, as you would know, Rich, lower than where they were a year ago. So it is still very good buying in the Sydney and Melbourne markets, but prices are rising again. And those latest auction results continue to support the prospect of rising activity this year. So it's important to realise that misinformation and ignorance remain the curse of Australian housing markets, of course, and we're trying to provide better insights with clearer data sets, and I hope commentary that is supported by the data. And of course, those that rationalise on the fear that it generates, they're the ones that make hay while the sun shines, if you understand what I mean. And I think there's a bit of hay to make at the moment, Rich, to be quite honest, and the data clearly supports that. And at the end of the day, particularly in Australian housing markets, there's nothing to fear but fear itself. And we've proven that yet again. So they're our capital city markets. Confidence is reviving and prices are on the rise. So that's me, a little bit late. I'm sorry about that. But there's the, I won't take this off because this is the QR code for the whole presentation. So you get the whole presentation, including the previous QR codes, if you take a little snapshot of that one. So I'm done, Rich. Few minutes over, but let's get on to some questions.
No, I love it. Thank you so much, Andrew. That was fantastic. Really appreciate your insights. And yeah, you're very much on the money in sort of translating some of those macroeconomic outlooks to where it is today. What we'll be doing, do you mind just unsharing your screen?
Yes,
and
yes.
I'm just going to share my screen now, if you can take that off. So guys, just got three little slides and then we'll open it up for questions. Thank you for those that have put your questions in the Q&A. And Theo, I'm sure we'll get some finance questions in a moment. But just a couple of quick points here. Obviously, a lot of you know about our services as buyers advocates, and what we do and can help you to do is to get into the market. Again, we provide a consulting service. We're not here to sell you anything. We purely act as your advisor along the whole buying journey. And these are the 7 steps you'd need to take. If you want to buy a world, you need to create yourself a strategy, create a buyer's brief, identify the right markets to buy in for your property strategy, and then start the searching process. Our average turnaround from when a client engages us to when they sign a contract on a property is around 30 to 60 days, because we're very efficient at searching and identifying the right properties in the right markets. And then we help you identify what to pay for that property, particularly in a moving market. We provide due diligence, pest and building, strata reports, etc. We facilitate those. We negotiate the price to remove all the emotion and then arrange settlement and property management services. From there, I guess the key things is what's the use of potentially using a buyer's advocate? There's a couple of things. One, it helps you to start the journey, to get the confidence to move forward, to identify markets that are going to deliver strong capital growth and consistent yield. It's also about getting access to opportunities you'll never see advertised, what we call the off-market properties. It certainly saves a lot of time, and we've made some significant savings by knowing how to make the right moves at auction and also in private treaty negotiations. And we're particularly good at crunching the numbers when it comes to investment properties as well. So we charge a fixed fee. As I say there, we'll be able to send you our schedule of fees, but it ranges between 1.5% to 2%, depending on the strategy and the service type you want. And you pay an upfront engagement fee there between 3 and 5K, but it really does give you access to all of those benefits as well. So look, all my details will be there on the slides afterwards, but what I'll do, I'll just take it off share for the moment. And let's get into some questions. So I guess one question is to kick it off. Theo, for you, it's not on the list here, but one question I've got is with high interest rates, what's some quick wins, some quick ways that borrowers can get themselves positioned to cope with high interest rates and get approval?
Great question. Actually coming up a lot these days. So all your bad debt is what I like to call it. All your unsecured debt is something that you need to deal with, unhealthy debt. So examples of this would be credit cards, personal loans, car leases, those buy now, pay later services like Afterpay. A lot of people don't realize that with credit cards, it's not your balance that gets factored in, it's the limit. So a lot of people think, well, no, I pay my credit card balance every month in full, but the bank doesn't care if it's the balance that you pay in full. It's the actual limit of the card that really does cripple your borrowing capacity. To use numbers, a $10,000 credit card limit could probably reduce your borrowing capacity by about $50,000 to $70,000. Afterpay and all those buy now, pay later services just comes out of your net income, and affects your net ability to service a loan. HEX is another one. The funny thing about HEX is that it's not the limit of HEX that is affecting your borrowing ability, it's the repayment. And the repayment of HEX increases as you earn more money. So the repayment is between 1 to 10% of your income based on your income amount. So that's something to be mindful of. The other thing that people need to be a bit more aware of is credit reporting. Your credit record has become a lot more thorough than it was in the past. If you are a couple days late on any form of credit facility, it will have an adverse effect on your credit record. So you have to make sure you're paying all your bills on time.
Excellent. Great answers. Thank you. Andrew, quick question for you. China-Taiwan potential conflict. How do you think that will affect the property market in Australia, and in particular Queensland? Do you think it'll have any direct correlation there?
No, not really, Rich. I think we're obviously in a more fluid environment in terms of what's happening internationally. We had the issue with the Ukraine war, which is now over a year old. That's sadly moved into the background. It probably had some influence on inflation, but I think that was probably a little overstated at the time. But now we just sort of seem to accept that it's moving on. I think there's a lot of jeopardy involved if we sort of move beyond, the talk of war to actually something happening. But certainly our relationship with China still remains quite strong. And if anything, it's strengthened because we now have resumption of permanent visas, students from China. And also China is now growing again, and it's starting to, if I could say, rebuild. But certainly construction is back in favour in China. And that, of course, means demand for iron ore and coal for their steel. And, that's good news for Australia going forward. Part of the success of our economy is we're a little country, just a handful of people. And yet we have all this wealth, particularly resource wealth. So, we live in uncertain times, not just economically, but also, in relation to conflict. And we just need to move on.
That's it. Question from Caleb asks, what's the probability of seeing a dead cat bounce in the market? Or another commentator calls it a false dawn. Does a growing risk of recession affect the market outlook into 2024? Andrew?
I think three months in a row of higher house prices, and they're still below where they were a year ago. And auction clearance rates are, pushing towards 80% in Sydney and Melbourne, particularly in Melbourne. I think that's going to generate more confidence with those that have been sitting on their hands. I think that's the thing. It's not just an interest rate story here, Rich. And obviously, the higher interest rates go, the more impact it will have on the economy. And the secret here, or not the secret, the thing to look out for here is higher unemployment. Because as long as people have a job in a low labour market that we have now, by that means we have low supply of workers, they're in the position to keep pushing up wages.
That's right. I think you comment about this. I think there's very little risk of recession. Very little risk of recession.
And if you get your interest rate increase, that offset that you say, okay, well, I need more money to pay my mortgage.
That's right.
And not everybody has a mortgage, Rich. In fact, most households either don't have a mortgage or have a mortgage that are owner occupied, or have a mortgage where they have a very low balance, or a lowish balance. So and savings rates are still high. So I don't think the factors are not there. And let's remember, interest rates are still around about 1% below where they were, official rates back in 2011, although mortgage rates are the same, which is a bit,
I've got a sort of question for Theo. Just this fiscal, no one's asked it, but it's sort of related, Theo. It's the fiscal cliff. What are you seeing, not just with your clients, but with other brokers, in terms of people's ability to cope with higher interest rates coming off their fixed rates in the second half of this year? Do you think they'll be able to manage, or do you think it'll be a bit of carnage?
Yeah, so like I was sort of touching on earlier, people are already well aware of that increase in probably half their debt, because like I was saying, a lot of people only fix around half their debt, not their full mortgage. And a lot of people are aware of that increase that's coming ahead. They're planning for it. The ones that are already coming off fixed rates, some are refinancing for better deals. Some people can't actually get a refinance approved, but it doesn't mean that they're not able to pay their mortgage, because like I said, the banks are assessing their affordability at a much higher rate, in my opinion, an unnecessary rate. But yeah, look, there are some people that are definitely, you know, stressed and worried, but they're people that have, you know, for example, something that was quite common during COVID was people buying either a second home or moving out into regional areas like Southern Highlands, Central Coast in New South Wales, or up in Noosa, for example. A lot of people with the work from home arrangements sort of took advantage of that. Those people are either selling those second homes or picking a preferred area that they'd like to live in, and just sort of getting into a more comfortable debt position as such. Yeah. But they're not in a, you know, arrears position.
Yeah, excellent. Someone's asked, seems construction is risky these days with builders going into liquidation. What should I be looking for? What questions should I be asked when choosing a builder? So I'll do that one. I'm actually building something at the moment, and one of the things I did was get a QS, the quantity surveyor, to do an estimate of what the actual build cost would be. And that also helps the builder. It costs us like $2,500 to get it done, but it helps protect you and the builder to know exactly what the costs are going to be. But I'd say to you, for this person, the key thing is to look at their reputation, make sure they've obviously got a license in the state, and make sure there's no sort of damages or liquidated damages claims against them. And also just get your lawyer to double check the building contract as well, but particularly looking at their track record and asking how many clients they've got, what their capacity is to complete the work. Tom is asking, is it fair to assume that the bottom of the market or bottom end of the market, cheaper houses units, will grow faster given people's borrowing capacity is limited? Yeah, well, anyone want to comment on, but I would say yes, definitely. I think the more affordable end of the market will definitely be quite competitive, particularly if the government continues to prop up first home buyers and give them more incentives, which has some unintended consequences. Theo or Andrew, any other comments on that one?
Well, it's a seasonal thing too, Rich. We're starting to see after a period of, I guess, underperformance from prestige markets, they're picking up, but it is the time of the year when we see more properties coming in from prestige. But yeah, you know, markets, particularly Sydney, the value aspect is always important because, you know, Sydney's the most expensive place to live in the country, you know. Yeah. And I think that's, you know, the good news now is it's less expensive than what it was a year ago, but don't hold your breath before it gets back to where it was a year ago. And that'll start, I would say, middle ring suburbs, you know, are quite positive in Sydney, you know, Canterbury, Bankstown, the Hills, the Shire, the South, you know, but we are seeing a pickup in the northern beaches, the inner west, the lower north now from a lower base, but that typically happens once we move out of the holiday period into May. So I think it's a challenge everywhere in the market, but obviously in high priced markets, you know, it's about finding something more affordable.
Yep.
Yeah, I tend to agree. I think the two good corridors in Sydney where we're focused is that southwest corridor and that northwest corridor that's benefiting off the new train line. I think in other markets, you need to be careful of supply. You know, the thing about Sydney, which is keeping prices strong, is the low supply, to Andrew's points earlier. They can't just build units and houses anywhere in Sydney. It's very hard. So I think buying land in Sydney, you can't go wrong.
Yeah, there are plenty of affordable pockets too in Melbourne and in Brisbane.
Yes.
And you know, definitely a lot of the Bayside suburbs and down toward Frankston, we're buying some really great quality properties there. And also in the south, the other eastern parts of Melbourne as well. There's some really good value. But again, you got to be careful also in Brisbane. You know, if you go too far west of Ipswich, there's a lot of land to be developed. So it might be cheap now, but it still might be cheap in the future as well. So again, it's really important to get independent advice around what the future demand for your property would be, because, you know, you don't know how well it's going to perform until 10, 20 years down the track. A couple more quick questions. What about the compliance with the ATO checking foreign investment requirements? Surely these are contributing to rising house costs. I don't necessarily agree with that, Andrew. Don't know what your thoughts are, but foreign investors are often seen as contributing to higher house costs. In fact, I think it's the opposite. We actually need foreign investors to help come in and help us build supply of properties, which can then defray the costs. What are your thoughts, guys?
Absolutely. I mean, we've run out of houses. We need more houses. Who cares who's building them? They can't live in them.
That's
Let's have
right.
permanent residency. We've had this conversation. Was blamed the strong market conditions 10 years ago, 8 years ago were blamed on that. There was a big conversation. And of course, once all the data came out, it was, fairyland stuff. It just didn't exist.
It's not the foreigners that to blame. It's supply issues. Actually, well, that leads into the next question. With construction codes and new construction requirements and building laws, there's some pretty strict obligations on builders now. So it's not only is the planning laws incredibly restrictive, the actual the quality of construction is very restrictive for a good reason too. So what do you think, guys? What impact will that have on the property market?
Red tape, green tape, you name it, any sort of tape is the worst thing at the moment for new building. It just adds to higher building costs, that are constraining development. So I know, specifically there is a lot of new land developments that are being proposed in Melbourne that are taking a long time to get to the stage where you can put a house on them because of all the hurdles you've got to jump through to get your infrastructure in, from state government. And it's just another problem adding to the big picture, which is we don't have enough houses.
I think Harry Triguboff came out publicly and said something pretty aggressive and bullish about this, which he often likes to do. And he was saying that New South Wales needs to probably keep up with Victoria and Queensland's attitude in terms of allowing developers to get sites out of the ground. It's both a state government and local council issue. I think that Harry was saying that if I can't do it in New South Wales, none of you can. And he's now, focusing on Queensland for that reason, because the red tape is actually just making it too tough to get houses or developments out of the ground.
There you go. Really good point. Someone's asking, it sounds like now's a good time for first-time investors to get into Brisbane. Agree, disagree? Anything worth being wary about that you haven't mentioned? I'll tackle that one. I think the Brisbane market is fantastic for investors. It's one that's affordable and has higher yields than you get, particularly in Sydney and Melbourne. It's not just because it's got the Olympics. It's got some great infrastructure and it's a transformational city. Every time I go and visit Brisbane, it's something else has improved. Great lifestyle. Great transport networks. So I think Brisbane's got a lot going for it. Again, you just need to get the right advice in terms of location and just be careful, particularly around flooding areas. Also, make sure you get your pest and building reports done because white ants, red ants, all the other kind of pests and nasties are a lot more prevalent in Queensland than they are in the southern states because they do like to chew through the wood. Let's have a look at some last two questions we can do. Prediction of sales volumes. What do you predict sales volumes will do looking into the future? That's by Martin. Great question. So sales volumes are down 25 to 30%. So vendors haven't been wanting to list their properties in a down market. And I think we're going to start to see a tick up in sales volumes. I don't think it'll get back to normal because people are holding their properties for longer. Andrew, what's your thoughts on sales volumes now?
Well, I think there's been a lot of misinformation about this, looking for answers of why we've got an upturn in the property markets. It's about, commentators, and was mentioned in the video clip, are saying it's a question of not enough stock in the market. That just doesn't add up. Most buyers are sellers and sellers are buyers. What we're doing is comparing it to a year ago and through a period where we had significant ups and downs in terms of creating pent-up demand and then releasing pent-up demand. A year ago, we had the highest volume in the shorter term of sales listings than we've ever had because we were getting all the flow through from the interruptions from COVID. And we're just not comparing like with like. We've got to move out of the COVID experience before we can start saying it's all about, a lack of stock, because numbers now are around about what we would typically expect, with not that there's a real typical expectation because cycles are always moving, but certainly pre-COVID, we're certainly looking at, the sort of numbers we would expect on average coming through. And look, I obviously there's still some buyers and sellers who've been hesitant to get into the market. But I think now with a clear signs of a market revival, And it's not just a dead cat bounce over 1 month. We're now seeing consistency here, and it is being supported by other data, such as the weekend auction clearance rate. So there's no conflicts here in the data. And I think that will mean more stock coming into the market, Rich. And we've got like 6 weeks until the close down of the season for winter. So I think it's going to be quite a heady period, to be quite honest.
Brilliant. Great. Look, guys, we're going to have to leave it there. Can I just wrap it up and say thank you so much, Dr. Andrew Wilson, for your insightful contribution. Thank you much, Theo Chambers, for giving us a perspective on lending.
Thank you.
My name is Rich Harvey, CEO of Property Buy. If you do have any other questions, I'm sorry we didn't get to them all, but we will be sending out the presentations in a PDF format. And please do get in contact with us if you are looking for help with a property. Andrew provides some great data. Theo and his team are fantastic brokers, can help you get your pre-approval. So it is a team approach. So look, say thank you once again. Please look forward to seeing you again on the next webinar, and have a great day for now.
Thanks, Rich. Goodbye, everybody.
Thanks, everyone.
Thanks, guys.